the RES doctoral training program is in its second year, and we are excited to welcome more of you. We have just commenced the spring term of this second year, and we encourage you to attend as many of these sessions as you can. Secondly, I want to thank the ESRC for supporting the program. Now, the masterclass format is that Professor Carol Alexander will be presenting and answering questions. There's going to be natural breaks in between where we can have these questions, but you're expected to ask your questions, place them onto the webinar chat, and then I'll be reading them out to Carol when the breaks come. Now, fourth point is that housekeeping, the RES Code of Conduct, which has just gone up, and I urge you to read this, and to give you a second to do that. Now, if there are any issues, if you can't hear properly or anything like that, please send in your message, and we'll try and sort that out with Maria, who's on standby here to help out. Okay, so I think we're all ready. Professor Carol Alexander is an expert in crypto asset and derivative markets microstructure. She's got a lot of experience in this area. She's been the editor of the Journal of Banking and Finance for 10 years. She's worked both in industry and in academia. She's worked at the New York Stock Exchange and in financial markets. She's had corporate roles as a director and head of market risk modeling for Nikko Securities, and as director of Algorithmic Inc., the Toronto-based firm, which provides risk modeling software to financial institutions and banks globally. Starting after the 1987 stock market crash, her academic research gradually settled onto mathematical and quantitative finance in a broad sense. Carol is a member of the Bachelier Prize Committee and the steering committee for the Center for Financial Industries at the Fields Institute. She sits on several advisory boards. She has a BSc in mathematics with experimental psychology and a PhD in algebraic number theory from the University of Sussex. So over to you, Carol. We are all waiting with bated breath to hear what you have to say.
Thank you, Kent. Very nice introduction. All right, so let me share my screen. Here we are, and this is what we're covering. And there are two parts. This is the first part, and I'm going to start immediately with some vibe coding using ChatGPT, but you can use any LLM if you want. Right from the start to end, I'm going to download some data, and I'm going to prepare it, and then I'm going to show you how to vibe code with GPT, and then I'm going to do the theory after that. And I'm focusing a little bit of introduction to ad hoc models, and then going on to just univariate modeling. And then I'm covering a couple of papers I wrote with one of my PhD students called Michael Dakos. And then we'll have some questions or just a break, or both. Some of you can ask questions, others can go on a break. And then we move to the second part, which follows a very, very similar format, only it's other PhD students who I'm talking about. For example, Daniel Heck did a lot of work with me on price discovery, and so did Andreas Cake. All right, so that's the basic structure. Maria said to me that it would be really nice if I did just talk a little bit about like career path, and that certainly is actually, it's on the spec of the workshop. So actually it's probably best if I normally do link to my website and other places, but I don't think I did this time. So look, here's my website, and there you can download loads of open access papers, find out more about me. You can also link to my YouTube channel where I'm putting up, this is the latest one on generative AI and then a financial risk management, very long one. There's a link to it there. This is the entire channel. I'm now working on a very, very large project on YouTube, crypto and blockchain. You have to log in here, just so I know who's taking my all my old lecture notes and stuff's there. My PhD students, you can look at their profiles here. I used to do an active blog. I used to write lots of books. This set in particular, the market risk analysis, has been a sort of standard for the last 20 years, nearly 20 years. In financial risk management, it's 4 volumes. Oops, there's my email. You don't want to read my email, do you? Right. Okay, so let's go back here. And about me, so Maria was saying, yeah, you should talk about, what you're speaking on is exactly what I did when I started to get into the city. That's why I've chosen these topics. Volatility modeling and co-integration. These are both basic building blocks in econometrics. And because I went early into financial econometrics, as Kent mentioned, it was following the 1987 crash. I thought, why am I doing game theory or algebraic number theory? I'd become a little bit more practical by then, having been to the LSE and learnt a lot about econometrics from James Durbin, he was still alive then, Andrew Harvey, and all the sort of Labour economists that are, now part of the Bank of England Monetary Policy Committee people there. So I did quite a lot of economics as well as econometrics. And then I learned about GARCH, and particularly the co-integration stuff, directly from Rob Engel. And in those days, it was really easy. It was the 1990s, right? And hardly anybody was doing it, let alone a woman. So I got to talk in conferences, and I was asked to do consultant work for these investment banks that used to exist in the city that don't exist anymore, like Hill Samuel, Robert Fleming, and places like that. They were, and also smaller asset managers, investment companies that, sort of, there were loads more. And nowadays, all the focus is on fintech. And that's where the SME growth is focused for careers. In those days, it was just standard traditional finance. And I programmed, actually, I didn't program. I used to program when I was a kid. But then I did program when I was a master's student, and then I sort of gave it up with all the algebraic number theory. Then I got back to using packages. But then my heart had gone out of any coding. So I'm really, really glad about vibe coding, because I can do what I've always done without having to have my head over the shoulder of a computer programmer, which is how it was used to work in the past, because ChatGPT is my computer programmer, and a really, really good one at it, as you shall see in a minute. Anyway, so that's what I did. I was the model architect. That's what I call myself, in certain terms of mathematical design of modeling, but then also iterating that feedback with the assistant and building models that tailor-made, like the very first GARCH models before there were any packages in the 1990s. And also, I think there's a paper that I referred to in probably this second, it would be this one, yeah. So I did some work in the 90s with Equitable House Investments and also Panoia Capital, these hedge funds and investments that led to academic work on pairs trading using co-integration. It's the earliest work, although a lot of people don't bother referring to me, as always. I reinvented. Anyway, okay, so Maria wanted me to talk about that. I've taken 10 minutes out of our schedule, and we haven't got questions until, well, for another hour at least. So let's start the business now, yeah? Okay, so let's get on to vibe coding a GARCH model. Here we are with the slides. And where I have embedded links, I can jump out, but I need to also look at my vibe coding here. So look, this is the workshop. I've cleaned it up this morning, and I've got the vibe coding GARCH session here that actually I did way before when I when I did the notes, and I'm ready to redo it. It won't go exactly the same. And you don't need that. That's my notes. You don't need that anymore. You don't want my email. So now I'm not going to be confused and taking you to my shopping list while I'm teaching you. Right. So what is vibe coding? Well, here am I in the 1990s. I'm the person who's shouting to the young man in blue or writing in an old-fashioned way, or even on pen and paper, stuff I want him to build. And of course, that's not something that I'm going to be doing for many more years now. I've found Claude, and I'm using ChatGPT because I subscribe. I used to subscribe to Claude, but it's really more for programmers, and I don't call myself a programmer anymore, even though, you know, it's all my life is managing programs. So I need to be just very, very clear, and then AI will automatically do everything for me, generate the code in Python and things like that. Small testable units, interactive and so forth. Test and refine, this is the important part. If you get your prompts right, there's less of this iteration required, and then I can produce, you know, a prototype risk model or some fintech rule. So this is, you know, building internal models that very, very quickly. It's not that it's any better, it's just it's quicker, everything's quicker. So let me just show you real time. What's the time now? It is 14:13. Okay, let's get some data, see how long it takes to, so for crypto data, best place, Bitstamp. A lot of these so-called exchanges that, exchanges that so-called provide data. I'm not going to do Bitcoin, we've done it. Let's do Ether. So let me take BTC, that crosses an easy one, but I'll take this one. Okay, so I've got Bitstamp. That is a centralized exchange. So this is tradable prices. They differ because there's like 10,000 different venues, maybe 1,000 different venues, where Ether, the name of the coin for the Ethereum blockchain, is actually traded. This is just the Bitstamp price data. Bitstamp is not much of a price leader. We'll find out in the second part of the seminar how influential various exchanges are in their price formation and price discovery. Okay, so I just downloaded that, and I need to save it as Excel. I need to clean it up, delete redundant info because there's an awful lot of Unix stuff, and I don't want the open, high, low, close. I want the close, don't need the volume. So, you know, trim it up, reorder as well because it's going to be in reverse order, as you can see. Keep clicking the slide. And make the dates nice, you know, 1st of Jan to whatever. And then, as always, you must plot. Everything must be plotted before you do any analytical work. Spend hours and hours, much longer than you think, plotting. So here we are with the slides, Bitstamp historical data, check integrity. We're going to go back to ChatGPT in a minute, and I'm just going to prompt like this. All right, let me take this over here so I can at least read the same prompts as you've got, make them similar. Those are the prompts that I got after editing. You know, I asked it, first of all, if it would help me with the prompts. I want to vibe. This is the first time I've ever even thought about vibe coding Garch, right? I've vibe coded a few other things. I want to do it live in the workshop. Tell me how to do it. Is there a special GPT? Well, there are, but there's no point nowadays. A lot of these special GPTs, although I do recommend that, you know, if you're actually learning material, you want to use this one. That's the one I built, the Socratic learning scaffold. Have a go with it. It's so much better at teaching you, and it stops it going off track. There are lots of other GPTs that you can use. Some of them, I've never seen anything like that, but you know, Excel specific, Excel analysis, Python stuff. But I'm just going to do this with I have a subscription, so I'm just going to do it with the Plus, which means I can set up a project and I can start a new project. I've got lots of projects. I put almost everything. You can see this, I tidy it up because I hate things being untidy. And anything that's disposable, I put in arbitrary chat. Delete the whole folder, and then I can start again once in a while. So that keeps it tidy. More than that, on my personalization instructions, which are pretty detailed, and yours should be as well, of course. So make sure that you've got all your preferences are put there. Custom instructions go on a very, 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 very long time. And these are overridden by any project instructions. So here we are. I wanted to look at the current project instructions. And the new way of running projects is that you don't have to upload them like you do at the basic settings, the personalization instructions. These just sort of evolve. So I have to, summarize them. What are they now? Because it's sort of live updating of all the instructions. It's an organic thing. So this is what they are looking like at the moment. I could actually, is a single paragraphed version of all these different rules. It started off and I said, what are the prompt instructions? And it gave me all the general instructions, and that's a mistake. I said, no, I want the project instructions. So it did it properly, be very careful. And there they are. So once you've got it in a project, and I did a lot more in this project, I've just kept the vibe coding threads here. So here they are, the vibe coding threads. And let's see whether I can do something very similar to this. And I will just check, first of all. Okay, GPT, I'm just checking that you have got the lecture notes for part 1 in the context window. Have they dropped out yet? I know I haven't been using many tokens today, so it should be fine. So I'm assuming you've still got that, but I'm going to have to upload you some data in a minute because I want a new set of Garch models. Okay, hang on a moment. Let's just clean up that data. So, okay, that's for later. File. Hang on, I've got to get a CSV file that I downloaded. Where is it? Here we are. No, that's my workload model. You don't want to see my workload model. Here we are. Convert. I don't want this to be CSV. Of course, it's universally compatible. Right. So I don't want the Unix. Don't want volume. Don't want low. Want the close. What am I doing? Here we are. Need the date. Don't need the symbol. Don't want open, high, low. Well, that's nice to take the intraday range as a nice measure, a model-free measure of statistical volatility. We are going to be doing something a lot more complex, and that's building a model of daily volatility. And this time it's going to be for Ether. So let's just trim things up a bit here. Delete that. Make sure we know that this is the price. This tells you it's SUSD, that's fine. Dates, got loads of zeros on them, but I don't know why. Why isn't this not moving across? Very odd. All right, so I do know, even though we can't see it, and for some reason this is column width. And everything goes wrong. Normally you just click it and then you can just move it across and it's not. Oh, it's there. All right, so better trim it for nice days. It's got to the end of January. Although it's fallen quite a lot the last few days. It's quite interesting. Obviously boosts the volatility. And reorder. Although it doesn't really matter with GPT, they can do it in either way. Maybe I won't reorder. Hope it doesn't produce. Honestly, I don't want to leave any boulders in its way. It will trip up. So sort oldest to newest. And also, yeah, I don't want these scraggly things. I'll start 1st of January. Or maybe the 31st of December, so the 1st of January is our first return. That would do. I'll save as Excel. CSV, it doesn't really matter, but I always prefer save things as Excel. And now I'm going to upload it here. All right, so here's some data on Ether and the symbol ETH against the US dollar. I want you to plot the data, first the price and then the daily log returns as time series in the usual way. And then pause and ask for further prompts. Step by step, little by little, you don't want it to do too much. This time of day, I'm using, that's another thing. I really don't get on so well with 5.5s. 4.0 is good for quick things. 4.1 is a sort of workhorse. I like 4.1, so I'm going to, I've just switched to that. Let's see what it's going to do. Taking ages. Now, I don't know why it's taking so long. I subscribe. I haven't used it today, so my token allowance isn't, token is a bit of a word. It's not being used up. We're going to have to come back here later, aren't we? Yeah, as always the case. So let's go back to this when I've finished the theory, because I can have a minute to spare, really. This is going to do that now. All right, here we are. You didn't like the Excel format. Okay, it's first time I've had that message, but okay, there's a lesson learned. Keep it as CSV. Wait a minute. CSV. Because I already colored it. Upload it. Open. Okay, okay, I'm needing to be quick. I'm using 4.1 now. I've got a live audience, so I really don't want you overthinking anything. So minimum thinking, you should be able to do this anyway. It's very easy. So, something like that file. Every time you think, I should have done it in advance. Come on. All right, okay. So as I said, these are very volatile right now. You can see the dates there. These are in your notes too. The notes have been sent, so you can read forward in the notes if you're getting bored with this. All right. So I'm just going to ask it to do a basic Garch model, and you can read this from the notes. I want to vibe code a basic Garch 1.1 model, a symmetric normal Garch 1.1. Do this step by step. Use Python. do not jump ahead. Just ask me before adding any diagnostics or extension. You need to estimate the symmetric normal GARCH11 and simply report the parameter estimates, and then plot the in-sample volatility series using the annualization factor as explained in the lecture notes. There are 365 days a year. Okay, so I didn't use the same prompts as in the lecture notes. I made very clearly what I wanted, but I should just say, I guess, keep the conditional mean equation very simple, just a constant, and we're just going to have normal innovations. I don't want any diagnostics really at all. I just want you to estimate normal by maximum likelihood estimation, and I don't want you to keep asking questions. I know that's in my personalization that you ask questions, but right now don't. Do this as quickly as possible. I'll give you 30 seconds. We'll see whether it can do that. Time. That's pretty quick, good. It looks sensible too. The persistence here, beta 0.909, which is what you sort of expect for crypto. That persistence is the first thing I look at. How long does it take for volatility to die away? And it's going to be, well, I'll explain more about alpha and beta. The sum of them, alpha and beta, is 0.982, so we haven't got a problem. If the sum was bigger than 1, we'd have a problem. This omega determines what we call the long-term or steady state volatility. This is just mu is the constant in the mean equation. I'm going to leave that for now, so you have an idea anyway, and go back to these slides. So here we are, back here. All right. And you saw me giving it some prompts. This is what you can copy and paste if you want with your own data. And these are the responses I got when I did this before, about a week ago when I was setting up these lecture notes. It writes down your conditional mean equation, your innovation distribution, and the GARCH11 conditional variance, and the innovation distribution there is normal. And this is the plot that you've just seen for Bitcoin, which goes over many more years. The Ether data started in 2018. But again, you've got even less persistence than the Bitcoin volatility, but this is over a different period. And the sum of them, again, is just about less than 1. We've got a few diagnostics about goodness of fit, the Akaike information criteria. Their convergence is because you use an iterative steepest ascent type method to maximize the likelihood function. So that's why it talks about converged. Let me disentangle all that stuff I just told you with some proper theory now. Right, we're going to get it into this and do it relatively quickly. There is going to be a recording. You can always slow down, ask Maria for the recording, and just watch it slowly if you need to. Okay, so we just saw this for Ether, but now it is for Bitcoin. You can see that the log returns I've put there. I usually prefer to use log returns. We'll see why, even though they're not traded. And there are some very strong jumps in both directions. Log returns of nearly 40% either way are not uncommon, but generally speaking, you know, these daily returns are in the region of 5 to 10% bigger than not 20 to 40%, as you can see in some of the extreme cases here. And prices are completely different animals. They're integrated or random walk processes. Returns are stationary, in other words, they're mean reverting. Okay, we've heard about random walks before. Given enough time, you can be anywhere. It's a random walk. It's part of the efficient market hypothesis that if prices of tradable assets are in an efficient market, then they absorb all the information there is instantaneously. So everything else is, the next price is just going to be an error. Okay, so tomorrow's price is just today's price plus an error. But you've got a very significant drift here. So you can have a random walk with a positive drift or a negative drift as well. When you say random walk, an I1 process may have a drift, but it doesn't have a deterministic trend. There's a difference between an I1 process and an I0 plus trend process. They look the same, but if you fit a trend and take the deviations from that trend, take the residuals of a regression of xt is c plus dt plus the residual, take those residuals, test for them, and if they're still I1 processes, then you haven't got an I0 plus trend process. But here we've got this hairy caterpillar type thing, and that's an archetypal of a stationary process, if not an IID one. So a stochastic process, xt, and I'm talking about a univariate process, x is just a scalar variable here. In the second part, x will be a vector variable because we're doing multivariate models after the break. So we write that x is the little twiddles, I0 meaning stationary, or more specifically weak or covariant stationary. There's something else called strong stationarity, but I0 means just weak or covariant stationary. It has a finite and constant, what we call unconditional mean invariance, and in other words, we write these operators instead of mu and sigma in parameter notation, we use operator notation, which is the expectation and variance operator there. They don't depend on time, at which point in that series are you looking at the expectation of the stochastic process as a series of distributions. So at any point in time, you've got a distribution, what's the expectation? And also the covariance, the auto-covariance between T and S, two different times. It only depends on S. And the strong stationarity definition is that the whole joint distribution only depends on T minus S, not just the covariance, the first moment of joint distribution. Okay, so that's a stationary process, and an integrated process of order 1, which we write x is I1, if and only if it's non-stationary, but its first difference is stationary. And more generally, an integration of order n means that it is non-stationary, but it's n minus once difference. The nth difference is stationary, the n minus once difference is I1. That's what it means for integrated order n, but we almost always just look at I0 and I1 in finance. I mean, maybe inflation in economics might be I2, I don't know, but not many things are I2. Right, independent identically distributed IID processes, I'm sure you all know this, but just to keep the level playing field, it's the most stationary kind of process. It really is a hairy caterpillar without any stray hairs. You don't get any of these bursts of hairiness. The IID process has just been to the hairdresser. So that means independent means you've got that full statistical independence. Okay, statistical independence means the joint distribution is the product of the marginals, and in the case of a normal, the distribution function is capital phi. That's the standard normal distribution function. It's the product of the two marginals. And that means they're independent. And it identically means that at any point in time, you've got the same distribution. When you cut through that process, what you see is one realization of the same random variable, identical copies. Square root of time rule is based on log returns, which is why I prefer to use log returns, not ordinary returns. The nice thing about log returns, as I said, you don't get them in your pocket. It's just the P&L divided by the original price that you get in your pocket. But the log return is additive. So in other words, the H period log return, in other words, the from 5 period or 10 period or whatever annual log return is the sum of H consecutive 1 period returns. So there you see, if we take the expectations and use the fact that this thing is IID, if they're not IID, which I should make a note on that slide, it's not perfect. The first thing's fine, but the variance needs IID, slide 16. Add IID on the variance, because of course otherwise you'd have the covariance terms there, and you need just to have this, because then the standard deviation, which is square root of the variance, is square root of h times the standard deviation at a 1 period log return. That's why we call it the square root of time log. And then when we annualize, and depending on the frequency of the data, if you start off with like weekly data, then what you get with that level is going to be your weekly variance or your weekly mean, weekly standard deviation. And then to annualize it, how many weeks in a year? 52. So it's square root of 52 times the weekly standard deviation. And that's what volatility is. Volatility is the annualized standard deviation quoted as a percent. So when we look at those graphs in more detail, we'll see volatility is very often 100, 200% in crypto. It is the most volatile financial asset. And the more I see things develop recently, particularly with the crash in gold and silver prices, because they're tokenized, right? They're traded on Binance. So that's why they've become volatile. Everything that gets on a blockchain, public blockchain, unless it's restricted, like the BlackRock Build token is only to certified investors. That's on a blockchain. That's money market, a money market token. But when you put the token for Tesla, I don't mind if Tesla becomes more volatile. Tesco, if you put the token for Tesco, and I wouldn't like to be the chief executive of Tesco if Tesco's being traded with 500 times leverage, which is what you can get on these, and there's no rules, right? So volatility is a really, really key thing in crypto. It's the thing. It's what makes crypto attractive. It's its volatility. Ethereum, yeah, it's supposed to have some intrinsic value because, yeah, it's the gas, it's the native token of the Ethereum blockchain, which underpins all of the growth of DeFi. But, I mean, okay, Ether will survive, I don't know what price. Bitcoin, its value is purely based on the fact that it is volatile. And, yeah, I'm sorry, this is a rant, I mustn't go on with that. Okay, now we're going to get into some modeling. And the stationarity, we've just looked at trend and seasonality. I'm not going to look at seasonality, talked a bit about trends. Autoregressive models we'll look at in part 2. And moving average models, our RMR models is very similar as well. We'll look at those more in part 2. Garch models is what we're going to be focusing on in this thing. But as an introduction, gentle introduction, remember the formula for the standard deviation of the sample x1 to xn. It's n minus 1 to the minus 1, not n to the minus 1, of the sum of the squared mean deviations. So it's the xi minus mu, or xi minus n x bar all squared. And the reason we divide by n minus 1 is that x bar required estimation before we could estimate the sample variance and hence the sample standard deviation. We call it s squared, and the sample standard deviation is s. But generally in finance, what we assume is that certainly at the daily level and certainly at the intraday level, maybe not at an annual level, but at a daily level, we assume the mean is 0. So we don't have to estimate it. So when we've got returns, financial returns R, we don't do R minus R bar squared. We just do R squared. And we take the last n squared returns, and we don't divide by n minus 1 now because we don't need to. We haven't lost a degree of freedom. Divide by n. And that gives us the historical volatility, so-called, which has been used in financial markets for 50 years. And you can see I've done a rolling window estimate. So I've taken the last 30 days and summed and squared the squared returns, averaged them, divided by them, and then annualized using the square root of 365 because I've taken daily data. It's my, the data tells you how much you have to multiply by. Data a daily, whatever you do, you multiply by square root of 365 in crypto or 252 in traditional markets. And you can see that the 30-day, 60-day, 90-day, 180-day historical volatilities are shown in this graph. And there are many times when, for example, in March 2013, the 30-day volatility jumped up to 320%. The 90-day volatility on that same day jumped up to 200%, and the 180-day volatility jumped up to 150%. So what was the right? What is the volatility? It's all ad hoc. We just have to choose a parameter and hope. And the problem about this is, the parameter we choose, i.e. n in this case, really has an effect on what your volatility estimate is. And also it affects how long that, for example, one very, very big positive or negative returns, for example, here, this is what you can see, this big negative return here, just one of them. Well, it becomes the yesterday's return, to put in the yesterday's return, t-1, and then it's the day before's t-2, and then it's t-30, and it still has equal weight. This is an equally weighted average, and then it suddenly drops out 30 days afterwards, and nothing happened on that day, but volatility went down from 320% to 50%. Or did it go down from 220% to 70% or whatever? I mean, well, how can you use this model? It's all ad hoc. Yeah, what it can do is maybe give you some parameters for a range. I mean, maybe we can say that the volatility of Bitcoin is somewhere between like 10% and 350%. Not much of a range. Now, in this equal weighting, suppose we introduce a parameter here called lambda that's less than 1, and we multiply this by lambda, and then lambda squared and lambda cubed, and then lambda to the power 30 is 0, because lambda's less than 1. So we don't have to stop. So I'm going to do it when I equals 1. You've got rt-1 squared plus lambda rt-2 squared plus lambda squared rt-3 squared. This term is here. So what have we got for the coefficients? Well, here we had 1, 1, 1, 1, 1, the coefficients of the r squared. Sum of the ones is n, divide by n. Here we've got 1 plus lambda squared plus lambda cubed. And what is that? Well, it's 1 over 1 minus lambda, isn't it? It's the sum of geometric progression. So the sum of the weights is 1 over 1 minus lambda. So that's why this comes on the top. It doesn't go underneath because it's 1 minus lambda to the minus 1 underneath. Okay, and then it's easy enough to show that we can rewrite this in a recursive form, so we can put it in Excel. And this is the form we use. We can put it into any code. And so you can see that these coefficients add up to 1. There is only one parameter. That doesn't tell us how we need to estimate it. We just make up a value for lambda, 0.9, shall we say, 0.95. Here, if we've got 0.98, you can see you've got a very smooth, that's why lambda is called the smoothing constant. And if you've got 0.9, well, it might seem quite large, but actually it's quite low in Newman terms for volatility. And there it's a lot more spiky. Okay, but you can't have one without the other. You've either got big reaction, that's the coefficient of RT squared. How much does a big return affect the volatility? So the reaction to the market is 1 minus lambda. And then here we've got the persistence. Forget what happened in the market, let it be 0. But if lambda is 0.9, then if variance was high yesterday, then it's going to be high today. Okay, so the hat means it's an estimate. We don't actually have any model for the parameter sigma here. We're just getting estimates like we did for the historical. And we can either have a low lambda, which means we get a lot of reaction, but then not so much persistence, and it's a jaggedy thing. Or we can have a high lambda where there's not so much reaction, but a very persistent volatility. And the volatility clustering, you can more or less capture that with Garch models. With the Yuma model. And Yuma was used extensively in the 1990s by risk metrics. JP Morgan originally produced this market risk, value at risk, internal model type software for, and the data for that was a very, very large covariance matrix for normal VAR models. And they used Yuma for that in the 1990s. But at the same time, I was programming these Garch models for Hill Samuel Bank, yes, Hill Samuel Bank Garch models. Oh. And learning this stuff from Robert Engel at the time. So that was fun. And so, yeah, they're designed to capture volatility clustering, which can also be quite asymmetric. So here I've ringed this, the first unusual return is a big negative return, and you get a lot of volatility. Typically speaking, negative returns upset the markets for equities or cryptos. Not so much really commodities, because one man's gain is another man's loss, you know, or foreign exchange, but certainly equities and crypto, they behave like this. And also, if there are anticipated announcements, you can get volatility building up to announcement. If it's good news, then you don't get volatility afterwards. So we need actually a model that captures this asymmetric volatility response. And these models came along pretty soon after Engel and his PhD student, Tim Boleslev, did the Garch model. Engel did the Arch without the Garch, more general type of time series. And then everybody uses Garch, it's much easier. And Nelson and Engel and Gloston all have different asymmetric extensions of that model. As I said, the Yuma can capture that volatility clustering. So here, for the same data, it's pretty old data, but this knot graph just shows that you can, with the right choice, you know, say 0.9 for the smoothing constant, you can get very, very close estimates. But the thing is that there's no proper estimate for the parameter estimation with Yuma models. And all they do is they produce 1 point estimate. And that point estimate now is supposed to be the same as your forecast over all future horizons. So, you know, you stop at this point here at the end, and it says, okay, 20% is your forecast for volatility over the next day, over the next year, over the next decade. It's going to be 20% vol from now on. Garch models have parameters that are estimated efficiently and consistently, generally speaking, using something called maximum likelihood estimation. And they generate an entire term structure of forecasts. I'll explain what I mean by that in more detail. Then you can, as well as the parameter estimates, you get their estimated standard errors, just like you do with regression or any proper model that you estimate in an optimal way. So you get these parameter estimate standard errors, and these can be used to yield entire distribution forecasts of volatility, not just a point forecast of volatility. I did some very interesting work with a couple of PhD students on this. First of all, Emisha Lazar, and then Sylvia Stănescu. Both of them were PhD students of mine when I was at Reading. Emisha Lazar is now a professor at Reading, and Sylvia was an academic for a while, but now she works in the industry, as most of my PhD students do. So you can find those papers in the references, and I pointed towards my website at the beginning of this session, where you can download most of the papers open access, and at least there are links, and hopefully your institution will give you open access for the older papers that don't have open access. Okay, now I use the term unconditional variance or mean. And I did explain what I meant by it. So here, let me explain. And I'm going to do that in the context of the autoregressive time series AR1 model. So that's the autoregressive model with one lag. And I think to change that C for the constant to a mu because all my other parameters are Greek. Slide 23. Sorry, I'm using C for constant, but there we are. So this parameter phi, if it's 1, then we've got a random walk. And if C is positive, the random walk has got a drift. It's going on. If phi is positive, it's going up. If phi is negative, you've got a negatively autocorrelated process. It doesn't stop it being a random walk. It's just if it's equal 1, plus or minus 1, you can have a constant. That's when we get a random walk. With the case that phi is greater than 1, then the whole series just explodes. It gets bigger and bigger and bigger, sort of exponential explosion type thing. So we're going to assume that phi is less than 1, so that x is stationary. And in that case, x is stationary, epsilon's stationary, it's IID, everything's balanced. And the unconditional mean and variance is a steady state where xt equals xt minus 1. And then substituting that in and rearranging using the fact that the expectation of epsilon is 0, we have that the expectation of x is c over 1 minus phi. And likewise, taking variances of the AR1 process, noting the variance of a constant at 0, and the variance of phi xt minus 1 is phi squared times variance of xt, which is in a steady state, same as variance of xt minus 1. And then epsilon has variance sigma squared. So these are the simply derived unconditional mean and variance. But the conditional mean and variance assume that this xt minus 1 is not a random variable. We assume we know some data for that. So the expectation, conditional expectation, conditional on knowing xt minus 1, the expectation of xt is c plus phi xt minus 1. And the variance is sigma squared only. Okay, the first part of it is constant. Okay, now we say that xt is in the information set IT. Okay, it's generally speaking, we also call it the filtration in continuous time finance. Similar sort of thing. It's what is known and is no longer a random variable. In Garch models, we just assume it's all the past returns of all the variables of interest. Okay, so the basic structure of a Garch model is that it has 2 equations. The conditional mean is a very simple linear equation. This is the stochastic part. In normal Garch models, we assume that epsilon is normal. We could assume that epsilon has a student t distribution. Let's do that Garch vibe coding, see how well it does. Or GED distribution and various other distributions. And they have the name GED Garch in that case. And the information set, as I said, is the past returns. And Boleslav's PhD thesis published in this paper. The conditional mean equations just defines the error distribution. It's the second equation, the conditional variance equation. And that is a deterministic equation. I mean, there was 20 years ago, Richard Hall, was trying to do stochastic Garch, trying to add stochastic terms here. Never really got off the ground. So it's the deterministic equation describing the evolution of the conditional variance, no error term then. And we need these parameter constraints, otherwise the variance process may not be positive or it may not be stationary. So particularly omega needs to be positive, strictly positive. Alpha and beta need to be non-negative, and their sum needs to be less than 1. We'll explain why when we talk about Garch forecasts, and you'll see the implications of the parameter sum alpha plus beta and what would happen if it were 1 there. Okay, so now MLE, the maximum likelihood estimation. Think of maximum likelihood estimation. Look at me. So suppose you've got a sample with x1, x2, x3, so forth. Okay, on the real line. And you, depending on the parameters, your density function could be there, or it could be there, or it could be there, right? Don't know where it is. Change the mean parameter, it slides along. Change the variance parameter, it goes like that. Change the skew parameter. So change all the parameters. And then change them so that this density really sits on top of that sample. And we can measure how close it is by something called the likelihood. The likelihood is just the product of the vertical heights. I mean, normally with density, we just look at the areas, yeah? But the height is called the likelihood. So if we make the likelihood of any observation is just its height under the density, the likelihood of the whole sample is the product of those. And we don't like products. So the log likelihood is the sum of the log likelihoods, right? So that's what we've got here. We use the log likelihood and the sum of the log likelihoods of normal. Well, it's easy enough to show that the normal density has log likelihood this, where this epsilon t is in the conditional mean equation. And there it is, this epsilon t. Okay, and the dependence on the parameters comes through sigma t here. Obviously, yeah, there is a mu or a c in epsilon, but the focus really, might just as well take the mean out of the data, then put it into Garch. So don't worry about those constants. And so sigma depends on these parameters, omega, alpha, beta in the symmetric Garch, but other Garch models have different parameters. So we may want to capture different features. We already know in the symmetric Garch that alpha, beta, and omega are used. Alpha captures a response. So compared with the UMA, where we had no omega in the UMA, that was 0. And we had 1 minus lambda here, and we didn't use epsilon squared. We used just the r squared, assuming that this already had 0 mean, so that r is the epsilon in the UMA. So we had 1 minus lambda in the first time, and then we had lambda here, so beta took the place of lambda, but alpha, if alpha and beta 1 minus lambda and lambda, then alpha plus beta is 1. And the problem with that is that you haven't got a stationary process for your variance. Another drawback of the UMA process. That's why you can't use it for forecasts. And then the long-term steady state volatility, again, we can derive this very straightforward. In the long-term steady state, the sigmas are unchanged. And this, well, what do we expect the squared error to be? What is the error again? It's this error here. What do we expect the error to be? 0, of course. Every error, you always expect it to be 0. But what do we expect the squared error to be? We expect it to be sigma t squared. Yeah, the expectation of the square is the variance when the mean is 0. So we expect epsilon t to be sigma t squared. So this is sigma t, this is sigma t, this is sigma t all squared. So we've got sigma t all squared is equal to omega plus alpha plus beta. Sorry, omega plus alpha plus beta sigma t squared. Turn those round and we get this. That's the long-term steady state volatility. So that's all uncovered from the one estimation. But we haven't got this asymmetric volatility response, have we? We haven't captured that. And what we want to do is to add another parameter now. So we can do this in various ways. The asymmetric Garch, or the A-Garch model of Engel and Ing, very nice, elegant model. Here you've got an extra term here. And if phi is positive here, then if you have a negative shock here. Epsilon is negative, and then minus something here. So this is going to be big. Whereas if epsilon is positive, you've got something positive and you've got the offset there. So the whole term is going to be small. In other words, unexpected negative returns, you get something big. They affect the variance model a lot. And unexpected positive returns, they have little effect on the estimated volatility. Okay, so we have parameter constraints commensurate with the other parameter constraints. We'll see how this comes in the Garch forecasts presently. The GJR formulation is also very good. There's not a lot to choose between these. I always go for the exponential Garch of Nelson, a very, very talented econometrician who sadly died very young. Otherwise, he was going really, really strong places. So, okay, this is the equation for the exponential Garch. Whereas here we introduce the asymmetry via this a gamma here, or via a psi here. Here we need other parameters. So this is beta 0 replaces the omega, beta 3 replaces the beta before. We've got the log now. We're modeling the log. So there's no need for parameters constraints as we had here to make sure that volatility never became negative. We don't have that because we're modeling the log. And then this G is where all the asymmetry comes. You can see what it looks like here. This asymmetric response as a beta 1 and beta 2 parameters can control how the how the variance responds to positive and negative returns in different ways. So, for example, in the red one, it responds very much to positive returns, but not negative returns. And this blue one, it responds a lot to negative returns, but not very much, but it still does respond to positive returns. Okay, now moving on to forecasting volatility. Here you can see two different term structures. Term structure is a snapshot at a particular point in time. It's not a time series, it's a snapshot of anything. You're used to term structures of interest rates, term structures of futures prices. And here we have a term structure of volatility. So with any term structure, the horizontal axis measures maturity. So if there were interest rates, we might have 1 year up to 40 years. Bank of England spot rate goes up to 40 years, right? And then you would just plot on the vertical axis, you plot the interest rate. And then generally speaking, you're going to have one of these sort of concave upward sloping term structures of interest rates where short rates are lower than long rates, but it can go the other way sometimes, as we shall see presently. Okay, now with this term structure, volatility term structures, like interest rate term structures, they can be increasing concave, they can be decreasing. And here I've shown a couple of decreasing term structure forecasts with different target steady state volatility. So they're very, very flexible. From one model, we can just estimate, this is the blue model, and this is what the estimated long run volatility is. The steady state goes and eventually converges to 13% or so. The red one is the same model estimate, the same data, but we're imposing a 10% steady state volatility. So eventually this red line will go down to 10%. I have only shown the first 250. So for example, at 50, this is the volatility of 50-day returns. This is at 100, this point here is the volatility of 100-day returns. So what do I mean by that? I mean from this point now until 50 days from now. So what are we talking about? End of March, the end of March, then we forecast that the volatility of whatever this thing is, I can't remember, S&P 500, over that period will be 15.5%. What does that mean? So after a month and a bit, 50 days, I've got a volatility of 15.5%. So that means that I've got a distribution for the S&P 500 index on the 31st of March. It's my forecast of that index. 15.5% volatility means that, you know, plus or minus 3 standard deviations. So plus or minus 45% of the point forecast. That's where the volatility expressed as an annualized percent. That's where the S&P 500 will be. Its volatility is expressed as an annualized percent. So it's projected into the, I haven't explained that very well. No, I haven't. I didn't explain that very well. I'll do it again, but not now. Okay, move on. Otherwise, I'll just bore you and I'll return to that and do it properly. Oh, yeah. I just thought I would show you some of my GARP's term structure from before. So this is the GARP's term structure I got from that estimated GARP's model of Bitcoin. Here is the Ether one I just did, but further up, I've seen quite a lot with it. There we are. This is the first one it produced for me. So here we are, chatting to him, iterating. So it did that forecast for me, and I said, now impose a long run volatility of 75%, compare it with the unconstrained. Didn't do it properly, right? And I had to pull it up. And then here, this was when I came back this morning, it couldn't upload the data still. I was looking at weekly data there, but I don't even need that data. Things drop out of the context windows, particularly large data files, so you might have to keep uploading them. And it's not good if you've uploaded something in this project, Vibe Coding Garch here, it's not going to be available in the Vibe Coding VecM here. So you do separate lecture notes for this part and data for that part, same for this. All right, back to the lecture notes. So constrained in the long-term volatility is 75%. You can see that it gets there pretty quickly. And unconstrained, though, it's looking closer to 100% unconditional volatility, steady state volatility. So the average volatility measured as an annualized percent over the next 100 days is 90 according to the blue and 72 according to the red forecast. And as I said, what I mean by volatility, it's at an annual level. So 1 year from now, wherever you look at a volatility, you've always got to think of a horizon 1 year from now, which is why I said I'm messing this up on the previous slide, because we've always got to think about that year horizon. 1 year from now, so S&P volatility is 20%. It means that you're sort of 99% sure that the S&P 500 is going to be, if it's 20%, it's going to be 60% below or 60% above your forecast 1 year from now. Volatility, like with a normal distribution, measures the dispersion about your point forecast. And this is telling us that the average volatility over the next 10 days, say, is 50 or 60, depending on which model you use. Or the average volatility over the next 50 days is 50 or 82. So let's write these forward variances analytically. And suppose we're using just symmetric for now, and we can always, here's the A-Garch one. Oh yeah, yeah. Oh dear, I thought I was error free. I've written these things just for you, but there's an error here. This does not want to be there. This phi, really bad. I didn't notice it before. I thought, yeah, no, that should not be there. I'll correct these slides. In fact, I made a lot of difference to the slides I sent to Maria. I didn't know she was going to send them out to you. I'll do the corrections and she can send them again to people attending. All right, so estimated up to time t, use a symmetric gauge, and then, okay, well, our estimated model is sigma hat t star at the very last thing is omega hat plus alpha hat, epsilon t star minus 1 squared plus beta hat sigma hat t star minus 1 squared, right? That was the last thing we estimate. Now we bump it one forward and we get this. That's fine. We know what the residual is on day t star. It was the last day in our sample. And we can find the residual on that day. But we can't find epsilon t star plus 1. However, the expectation of epsilon squared is sigma squared. Yeah, that's something we already looked at because its expectation is 0. The expectation of epsilon squared is the variance. And so we can substitute epsilon t squared and instead use sigma hat t plus 1 squared, sigma hat t plus 1 squared, and so forth. And so we have this iteration, and now we can see why alpha plus beta should be less than 1. It'll explode if alpha plus beta is not less than 1. The variance estimates will just get bigger and bigger and bigger. Okay, so here we have 2 alternative statements of forward variances. But that's just, it's not the term structure. These forward variances are not the same as I've shown here. They behave in the same way, but as I tried to emphasize when I was talking about this several times, I said, this is the average volatility over the next 50 days, right? It's not the 1-day volatility on day 50. No, it's not that. However, the forward variance is. This is the 1-day variance on day t star plus n plus 1. It's the daily variance, not the aggregated. So we need to aggregate those forward variances. So we do these steps. We generate a series of forward variances, and then we add them up. And that gives us approximate H-day variance forecasts. We add them up using similar logic to the square root of time rule. In other words, we're ignoring those covariances. However, we know that there is not auto independence. You know, it's no serial independence here because it's a gauge model and we've got dependence in the higher moments. The volatility is correlated. So the IID is not the assumption we can make. We are simply ignoring those covariance terms, actually. We weren't ignoring the terms here when we did it for the IID model. I did we do it for IID? Oh, all the way back. Oh my goodness, here. Right? There were no IID if it's, there were no terms if it's IID, there are no covariance terms. But here, when we add up the variances, we are ignoring covariances. If you look in my books, Market Risk Analysis, you'll see detailed calculations of what happened to those covariances in a footnote. It's about half a page long. Okay, so then we turn this H-day variance forecast into an H-day gauge volatility forecast. And we do use the same annualization factor, even though they're not IID, we still presume that it's this market convention that when all standard deviations are quoted as annualized volatilities, so we know what we're dealing with. We can compare something that has a horizon of 10 days with a horizon of 20 days, for example. Comparing like with like, that's why we annualize. So the forward volatility forecasts, we know they converge to the long-term steady state, because this is less than 1, alpha hat plus beta hat is less than 1. That means they converge. The only point they don't converge is when alpha hat plus beta hat equals 1. So we can also fix the long-term volatility, as I explained before. And this is the algebra for that. We use the equation here that we derived, turn it around for sigma bar, and get rid of omega. So we can express omega in terms of our assumed sigma bar, and then just estimate alpha and beta and not omega. So we fix omega with our sigma squared and whatever we estimate for the alpha and the beta. In other words, we're going to put in the model, our feed into the model, not the returns, not even the returns after we take the residuals after regressing on a constant. We take the return mean deviations, that's what these are, and then we take the deviations of those from the square of our chosen, our selected long-term volatility. That is the data we put in. We do not estimate a constant, and we estimate just alpha hat and beta hat, and that gives us the form that I used to generate those term structure forecasts. We can also, interestingly, turn this equation around in another way and write it like that. And this shows that the volatility today is going to be somewhere between yesterday's volatility and the long-term steady state volatility. In fact, there's a linear interpolation between the variances, plus some uncertainty, some error here. So there's a wobble on top of it. It's not purely stochastic. Finally, and I'm bearing in mind the time because I don't want to leave it too long before I start part 2, and we still have these results to go through before we get to Q&A. I'm going to be talking about a couple of papers, as I mentioned earlier, that I did with Michael Dakos. One is published in, they're both published in quantitative finance, and they're both using just daily data on crypto to do GARCH models and various other stuff. And you can see on the left-hand side here, there was the quantitative finance was very happy with this paper because it gave them a real headline. Less than half the cryptocurrency papers published since January 2017 employ correct data, which was true at the time. Hopefully it's a bit better now after that paper. And then the other one, the 2023 paper, had more crypto, not just Bitcoin, but Ether, Ripple, and Litecoin, and did volume weighted average prices from Crypto Compare, produced these. They're not traded prices, they are weighted by the volume of the exchange, so their price is taken from Bitstamp, Bybit, Binance, Coinbase, and all the other exchanges, Kraken, and so forth. And depending on the volume, the price has more weight in the average. So they're not traded prices, they're VWAP prices, and they go up to 2021. So I'm just picking out Markov switching GJR GARCH on non-traded and traded BTC data. I do prefer eGARCH, and eGARCH are much of a muchness with the GJR, but Michael, who was doing this modeling, he felt more comfortable and more steady with the GJR, and the Markov switching is a very delicate thing, but clearly necessary. In Bitcoin, we go through periods of not very much volatility. Last year, Bitcoin was not very volatile at all, or Ether, all of them, until the end of the year, and we've had a huge amount of volatility since then. This happens all the time with crypto. At least 2 states of volatility. So we impose two different states, and so we've got two different Garch models. And we've got one alpha 1, gamma 1 for the asymmetry in the GJR, and beta 1. And then we've got the state transitions and the GJR parameters, further parameters. So P11 is the probability that you stay in that state. P22 is the probability that you stay in state 2 as well, which is much lower. What we can see, I'm just picking out data from CoinGecko, Econometrics, Crypto Compare. These are all non-traded prices, VWAP. Then Bitstamp and Kraken. Nothing particularly unusual about these data. But with CoinGecko and Crypto Compare, we've got this unusually high omega, highlighted in blue here. And here we've got a range minus 0.097, 0.035. And this Crypto Compare estimate isn't even in the 95% confidence interval for the crypto, for the CoinGecko, and so forth. So I've sort of highlighted some anomalies here in terms of the confidence intervals and the parameters. Econometrics data seems to be the healthiest data, but all data have this feature here where you've got positive and negative asymmetric effects. So the high volatility, this is the low volatility, unconditional volatility of this one is 49.6%, 50%, also 50% with the Crypto Compare, very similar data. But according to Bitstamp and Kraken, which I tend to rely on more, the low volatility states are 36% and 14% unconditional volatilities, or maybe 21%. Anyway, they're all very different. So yeah, that's strange. And also for the high volatility, is it 216, 170, 204? Or is it much lower? Is it 115% or 106%? Again, the CoinGecko. There was a lot of problems with CoinGecko paper data. If you look in that paper, you'll see we were working with Crypto Compare, doing building their price indices and doing quite a lot of work with them on the best VWAP methods, and came across a problem with CoinGecko at that point. So if you're going to use aggregated data, then I would probably go with Econometrics, but otherwise you can get it free. You just download it using the WebSocket API or just the usual REST API socket at the exchange. Another thing that I want to mention is that this paper was published in 2023, so this is the second paper. And look at the number of papers, ridiculous. We from 2011, people started, get some data. Let's now use a normal or a student T or a GED or various different types of Garch models. Let's have a look at different criteria to select them. Let's see which is the best Garch model, which is the best Garch model. All this research on which is the best Garch model, it only goes up to 5 years ago. I mean, this is still going on, and you don't really need Garch. You know, Yuma does an awful lot of what Garch does. And if you are going to use Garch, then student T, GJR, student T, eGarch, Markov switching would be good if you can get it to work. Okay, so we used this in this paper for forecasting value at risk and expected short call. Now that the fundamental review of the trading book is implemented, all banks and major companies are focusing on expected shortfall as a different risk metric, which is the average of the losses in excess of the value at risk. And so we did back testing of those as well. And just to wrap up, green means good, red or pink means not good. And we can see for long positions on Ripple, anything's fine actually, apart from our benchmark. I can't remember what that was. Probably just a random walk or something. but for Bitcoin and at the 1% particularly, that's these results here. The AUMA is good. The AUMA, so I was using just the asymmetric, not the GJR formulation here. With UMA, you can make it asymmetric in an ad hoc way, and you can do just as well as you do with EGARCH, which I used here. And the same applies for short positions. This AUMA with good choice of parameters is, you can do one GARCH model. Well, you're not going to estimate GARCH models with tailor-made in-house units. You just do it once, then make yourself a UMA, and then everything else can be programmed from that. May not be quite so true for Ripple and Litecoin, but really when it comes to crypto, as I said, Bitcoin and Ether are really it. So these are the references to the papers. They're not all my own. These also from Boleslav, Engel, and Nelson and Jostin. Okay, so I have gone 15 minutes over, but I don't mind. I'm not going to take a 15-minute break myself. I'm feeling all right.
Thank you very much, Carol. We actually got quite a lot of questions here, so I'm afraid you can't take your break. First of all, I apologized. I asked people to put questions in the webinar chat. In fact, it's got to go into the Q&A box. But I do have one question from Augusto Costa, who asks, what robustness tests did you use to select eGARCH or GJR GARCH?
Well, there's lots of information criteria. There's the Akaike or Bayesian information criteria that provides a diagnostic of in-sample fit. But robustness tests, sure. I mean, one can always, I was planning to do that if I've got time to separate into two samples and do some co-integration again over subsamples, and that's the next thing on the agenda to check robustness. That's how one normally would do that. And in that paper, I really can't remember. I do know we did an awful lot of testing, whether we put it in the paper or not. No, we were very, very meticulous about diagnostics and things, but dividing the sample into two and looking at how robust the parameter estimates are is probably something I didn't do, whereas I might have done that on FTSE 100 or something like that. I wouldn't, or S&P or some equity index, I wouldn't do it on, because the crypto market's changing structurally all the time, that you don't expect that much robustness over samples, really.
Okay, I hope that answers your question. I have another question from Benji. Can you elaborate a bit more on why tokenized assets are more volatile compared to, say, stocks on a regulated exchange?
Oh, this is okay. I did invite it. Yeah, it's because the normal trading practices that are used on the stock exchanges that are regulated do not involve layering, spoofing, laddering, and so forth. Okay, they do involve 99% of orders in the limit order book being cancelled. That's for sure, but they don't include these this market abuse, basically manipulating prices up or down or whichever way you want to go. And not only is this done in all the unregulated exchanges, they offer something called a perpetual token on virtually everything. It's not exactly a future. It's called a perpetual futures or perpetual swap. But it's basically the closest thing to spot you can get, although it is a futures contract with no maturity. And the only thing that ties it to the spot are usually 8-hourly funding payments from long to short if the perpetual is above the spot, or from short to long if the perpetual is below the spot. And that it's a very tight basis every 4 hours, sometimes every 8 hours. So the perpetual is really, really tight. But you can get leverage on spot. You can trade up to 10 times, depending on how your margin account is cross-margined or whatever. 10 times your notional you can trade on spot. But in crypto, MEXC offer 500 times leverage on some things. But, it has to be a small position. But, with an average, one of my papers, I calculated average leverage for around 20, 30 times. So that 20 times leverage is 5% margin. In other words, if you've got a long position, you've taken 25 leverage. If the price falls 5%, your margin's wiped out. And if, Bitcoin can fall 5% in an hour. So people that trade these things, and there's an awful lot of at-home traders, more and more nowadays, what with the way the world's going and unemployment and young men needing whatever, and everybody's trying these things, and they're being beaten by Jane Street and Jump Crypto and DRW and all these gorillas out there, because they can do what they like. They can put up 100 times leverage and they spoof prices whichever way they want. All they need is volatility. Okay, BlackRock, with all its ETFs, definitely wants direction. And I've been, because I speak in the media, making, the main news, making quite sharp comments about, BlackRock really need to get their act together if they're going to defend the Bitcoin price, because it really is just a battle. It's a football that's being kicked around on a football pitch without a referee. There's, these exchanges are their own clearinghouse. There's no independent clearinghouse. And the way they clear these trades, these highly leveraged trade, one highly leveraged trade, wipe everything that's covered by that margin account out, right? One trade. So even you've got a really profitable trade on Solana, that's going to be taken away from you. And the exchange's clearing mechanisms are all automatic. Everything's sold straight away. It's not supposed to be, but it's immediately dumped on the market. And so what you find is this awful pro-cyclical behavior created by the clearing mechanism. So when you get Jane Street wants to create 3 a.m. on a Sunday or Monday morning, Sunday night, Monday morning, that's the best time, right? And they want to create some volatility that day. There's a bit of news, something to do with, I don't know, China or whatever. There's a bit of news. Okay, let's use this. Let's create some volatility. And Jane Street tells Jump Crypto, okay, it's your turn to make today. You're going to make the profits today, because they don't want to trade against each other. So they create a bit of volatility, 3 a.m. in the morning, and then loads of ordinary young men get wiped out from all their portfolio completely. This happens all the time. And then the exchanges take their positions and dump them on. So they take the long positions that have got wiped out, dump them onto the market, and then create a flash crash out of nothing. The Jane Street and Jump Crypto did not want to create a flash crash. They just wanted to create some volatility, but the exchange turns it into a flash crash. So that's why gold and silver have been so volatile now, and I don't know how that's going to stop, because they've been tokenized. Everything's being tokenized. Everything will end up tokenized, traded 365 days, 24/7 on a blockchain. But you see, this is a massive subject. That's why I'm doing the YouTube channel. The next YouTube channel is going to be all about level 1, 2, 3, 4. I showed you my website that maps it out. I'm working on that when I can. I'm halfway through level 1, because it's really important once everything moves to blockchains to understand this.
Okay, thank you very much, Carol. Got a question here asking, in one of your slides, it was assumed that VAR followed a student's T. He would like to hear 1 or 2 arguments behind this choice.
Why it should be to student T rather than normal, and I should argue why it should be to student T.
Yes.
Yeah. Well, you've got an extra parameter, you can fit better. And, returns are They're just not normal. We only assume normal for tractability in the theoretical developments, you know. When it comes to practice, we're all, I mean, I just did the normal because that is the vanilla one, you know, but hang on, I don't have time, but you could just as easily have asked ChatGPT or Claude or whoever you use to estimate a student T-Gotch. And the volatility clustering, you know, the sort of expansion and contraction of volatility is not enough. You need, you know, the normal, it's not, even if you add that expansion and contraction, you have to get away from the normal. There's asymmetry as well. So, you know, a skewed T is even better than an ordinary student T.
Now, I think we have used up quite a lot of our time, but there are a couple of similar questions that are coming up. So perhaps we could just try and do them in one, as it were. And this one is from Alfonso. In your experience, how does the Garch models for options and term structure perform against other models for volatility surface modeling? And there are other questions of similar vein like that.
Garch modeling for options. Yeah. Can you just repeat exactly what that question is? Because I mean, I can talk about it, but I just want to know I'm getting the right thing.
Okay, I'm reading the question verbatim here. How does Garch models for options, volume, term structure perform against other models for volatility surface modeling, such as Bachelier 76? Have I got that right, Alfonso? If you'd like to qualify that. Or alternatively, I have another question that says, oh, here we are.
Hello, Alfonso.
Hi.
Show yourself.
Hi. Yes, thank you. So what I was trying to say is how, in your experience, Garch models can be used for the modeling implied volatilities on term structure on the option chain against other, more complex but different type of, surface models like the Bachelier 76 or the ones that are used for, swaptions and all that. I like parsimony in particular, so I just wanted to have your take on that.
Okay, so using Garch in terms of modeling the dynamics of implied volatility surfaces is not something that I have even thought about. And how one might do that, not even sure. However, modeling the dynamics of volatility surfaces implied volatility surfaces is done very nicely using principal components. And I did that, I can't remember, 10 years ago or whatever.
Yeah.
Rama Kant also did quite a lot on that. So you just decompose the surface into its principal components.
Yeah.
If you know about that. Yeah. And the use of Garch type, i.e. non-affine continuous time processes in option pricing models is something that I've also looked at. You can see some papers with Andreas Cake on that on my website. And that, everybody tries to add bells and whistles to Heston because it's affine, and so they can estimate it. And so they add a jump in the vol and a jump in the price because you need that, because that square root process is too constraining. But the log normal process with the Garch, which doesn't have the square root, is much more flexible. So volatility is free to come up and down, and it does an awful lot better than Heston. And now, we don't really worry too much about analytic solutions. So so I think it's a lot better than Heston. But having said that, the industry is moving much more towards things like local volatility and local stochastic volatility for estimating rather than these parametric models like that. So when it comes to modeling dynamics of implied volatility surfaces, then you've got a huge dimension that with a Garch model you need to summarize, and you could look at the components. And then with principal components, because they're orthogonal, you can use something called orthogonal Garch which I
Yeah.
did way back before, and then I didn't really publish it because I went to work in the industry. But it's the OGARCH model, which would be a good way of modeling those dynamics once you've got the principal components.
Perfect. Thank you very much.